Is there a way you can pick out cryptos at extremely low prices and make huge returns with as little risk as possible? All doing this without worrying about trading and looking at charts all day. Sounds too good to be true? Well, there is a way. In traditional stocks, there are two basic approaches when deciding to choose a particular stock. The first one is technical analysis. This is the one you are mostly familiar with. You will find a lot of YouTube channels about traders and analysis of price charts in crypto. The second one, which doesn't get quite enough attention, is fundamental analysis, which is what I'll cover today in this video. So in this video, I'll go through what is fundamental analysis, why is it important, and how should you use it in crypto. And by the way, I won't be covering how to do fundamental analysis in this video. If you'd like to learn more about how to do it, you can watch my video on how to do basic fundamental analysis. It gives you 7 key things to look out for when doing fundamental analysis. So if you're interested, check it out. So what is fundamental analysis? Well, in traditional stocks, fundamental analysis is simply a method of measuring a stock's fair value or intrinsic value. Unlike technical analysis, fundamental analysis digs under the hood of a company to study anything that can affect the stock's value. These can be generally broken down into 2 groups, qualitative and quantitative. Qualitative refers to generally understanding the economic environment the stock is in. Things like business model, competitive advantage, the management team behind the business, the stage of development, regulations in the industry, and macroeconomic factors such as inflation, unemployment, and economic cycles. And quantitative refers to things in the stock that you can measure with numbers. Things like cash flow, balance sheets, earnings per share, and market share. The idea is to combine this analysis to help you identify the true value of a stock. This number is then compared with the current price of the stock to see whether it is overvalued or undervalued. But why? Why would you try to find out whether a crypto is undervalued or overvalued? Don't you just buy a crypto when it's going up and sell it when it's going down? Easy peasy. Well, first off, if you thought that, then give me a few minutes to take you down memory lane. Back in the 1930s, there was the Great Depression, a worldwide economic depression that started in the US and affected most countries around the world. This depression left a scar in the minds of many people. And just to give you some context, worldwide GDP during the 2008 recession declined by 1%. During 2019 cerveza sickness, worldwide GDP declined by an estimated 4.5%. But during the 1930s depression, worldwide GDP declined by 15%. That's 3 times more than the downturn caused by the cerveza sickness. It was a very tough time indeed, and as a human race, we learnt many tough lessons, and one of these lessons was shared to us by Benjamin Graham and David Dodd. These 2 economists laid the groundwork for fundamental analysis and value investing. Their book, Security Analysis, is one of the most influential books ever written, and is amazingly still relevant today. You may recognize one of their students, Warren Buffett. Benjamin Graham and David Dodd wrote the book in 1934 after the massive losses on Wall Street during the Great Depression. They found that many investors had the tendency to irrationally overvalue certain stocks, leading to larger losses on downturns, and irrationally undervalue other stocks, leading to lost opportunities for higher returns. They created an entirely different approach based on this, which involved measuring the rough value of the actual business behind the stock. You can refer to this as intrinsic value. Let me give you an example in crypto of how intrinsic value would work. Say that a crypto's price is trading at $100. After fundamental analysis on the crypto, you actually find that the crypto's real value is $200. So you can say that this crypto is undervalued, as the real value is higher than the actual price value. You can then buy the crypto with confidence, knowing that its real value is actually higher than the current price. This represents your potential return on investment, as the price would eventually reach the real value. Alternatively, say that a crypto's price is trading at $100, but after fundamental analysis, you find that the real value is actually $50. So you can say that this crypto is overvalued, as the real value is less than the current price. You can then choose not to buy it, or sell it if you do have it in your portfolio. This sounds great, doesn't it? Yes, it does. And with names like Warren Buffett, who are avid users of fundamental analysis, who's to say you can't make money using this approach too? However, there's one thing to bear in mind. Now, say that you've done fundamental analysis on a crypto and you have an idea of its intrinsic value. One assumption in fundamental analysis is that in the long run, the price will eventually reflect the intrinsic value. However, the thing is, you don't know how long it would take for the price to catch up. So inherently, fundamental analysis favors the long-term investor more than the short-term trader. So, if you're looking for short-term gains, it's probably better to focus on technical analysis instead of fundamental analysis. So, to sum it up, by focusing on underlying factors in crypto, you can estimate its intrinsic value and find opportunities to buy it at an ideally large discount. Your investment then pays off when the market catches up to the intrinsic value. Okay, this all sounds great, but how do you actually use it in crypto? Now, discussed at the beginning, I won't go into too much detail on how to do fundamental analysis in this video. But fundamental analysis in crypto is still being developed. Since the crypto market is so new and different to the stock market, the traditional methods in fundamental analysis do not directly apply to crypto one-to-one. Things like cash flow, statements, and balance sheets do not really apply to crypto, since these things are based on looking at companies. As crypto is decentralized, there is no actual company to look at. So, new ways are being developed to do fundamental analysis on crypto. So, going back to how you use fundamental analysis in crypto, you need to have the right mindset, as fundamental analysis is intensive and involves a lot of detective work. It also suits the long-term investor, which may or may not suit your personal finance goals. Before you even think about using fundamental analysis, you should ask yourself these two questions. So, the first question is, what is your time horizon for the target amount of money you want to make? And what I mean by this is, how fast do you need the money you want to make? Leave a comment below on how soon you want the money. Is it 1 month, 3 months, a year, or you don't really care? You're in it for the long term. If you need the money in 3 to 6 months, then a long-term strategy may not work out for you, and I probably would recommend you follow an experienced trader to help you make trades. This is going down the technical analysis trading route, and since you won't be an expert in 3 to 6 months, following someone who you know for sure is would give you a better chance at making that money. However, please be aware, this is a risky route, and it's probably more intensive than fundamental analysis. You should really treat it like a full-time job. Alternatively, if you're happy with making money at least a year from now, then you should think about using fundamental analysis in your crypto picking. This is not to say fundamental analysis is not risky when compared to technical analysis. It of course all depends on the quality of your analysis and decision-making skills. However, it is less risky, as you won't be actively managing money all the time. and you're more likely to invest in cryptos that give higher returns over the longer term. So, once you've decided how fast you need the money by, the next thing to ask yourself is, what is my personal belief in investing in cryptos? And what I mean by this is, do you think it's possible to outperform the market through analysis? See, when you buy and sell in the crypto market, you're actually competing with millions of other traders and investors. And if you buy a crypto, let's say ranked 5th on CoinMarketCap, you're basically saying that you know more than crypto investors who buy cryptos ranked 4th, 3rd, 2nd, and 1st on CoinMarketCap, and believe your 5th ranked crypto will outperform them. If you do, this means you believe you can outperform the market. However, if you don't believe that you can outperform the market, then the market is correct. You should just buy whatever the highest ranked cryptos are and diversify accordingly. I personally believe you can outperform the market. As the crypto market is so new, with so many new people coming in every single day, I'm pretty sure 80% of the participants in the market have not done proper research on every single crypto they hold. The market is very young and emotional, buying cryptos which pump up in price and then selling it next week when they see it going down. I personally believe there are a lot of undervalued crypto projects out there, which I'm pretty sure most people have not even looked at, which have the potential to make you life-changing money. And this is why I use fundamental analysis. So, if you don't mind getting the money a year from now, and you believe you can outperform the market, then you should focus on fundamental analysis. This is not to say you can't use both fundamental and technical analysis. So, that's the end of the video. Thank you very much for listening and watching. If you liked the video, again, hit the like button and subscribe. I make videos like this every week. Short videos on fundamental analysis and deep research on what I've found in the market, which I think we can all benefit from taking a little bit more time to study things with more thought and with more deliberation in today's era of everything being instant, emotions on a whim, attention span of a goldfish. I think we can all benefit from delaying a bit more of your gratification and just taking a bit more time with things. Thanks again, and see ya.